Hello everyone, welcome to Decision Time. I'm Sylvia Mauro. The European Central Bank is set to deliver its first monetary policy decision of the year in less than 15 minutes time, with markets widely anticipating another 25 basis point cut. That would take the deposit rate to 2.75% and mark the ECB's fifth cut of this easing cycle. Europe's lenders see today's likely cut as the first of several this year, with the latest poll by Reuters forecasting the ECB's key rate will be down to 2% by the middle of this year. Now, Karen had a chance to speak to the ECB president, Christine Lagarde, in Davos last week and asked her whether she agreed with those on the governing council pushing for further cuts by the summer. Take a listen.
I leave it to them to sort of anticipate and play that game of, so many at which pace and blah, blah, blah. We have a methodology, and my job as president of the ECB is to make sure that we apply the methodology properly, that we project as well as we can, that we take into account empirical data as well, that we use our judgment. And we have to be very attentive to the rest of the world. I'll be attentive myself to the price of energy. I think that one of what probably we have not yet anticipated is the decline in energy prices, and we'll see how that pans out and what impact it has on us. So I would refrain from 4 or 3 or over the course of what time, and when do we get to 2, or is it going to be 2.25, or let's take things one step at a time.
Christine Lagarde there speaking to Karen last week in Davos. Let's get a check on how we're moving in currency markets ahead of that rate decision. Thinking about the euro-dollar has been a very interesting session and overall an interesting story for this pair. At this stage, we have the euro tracking lower against the US dollar, but marginal moves really here. Let's see whether this is going to change with the rate decision, if it indeed comes as expected with another 25 basis point cut. But all in all, the euro at this stage tracking at 1.04 against US dollar. In terms of the bond market, let's get a check on that too, so we get a better idea of what's happening in the bond space too. At this stage, we have all of the major European bond yields moving lower ahead of this decision, continuing indeed that trend that we had witnessed since the start of today's trading day. We are seeing lower pressure when it comes to bond yields. But of course, there are several points here. It is what the ECB is going to tell us later today. But of course, markets also pricing in what the Fed has communicated yesterday. Let me show you the different European equity markets too, so we see what's happening there as well. It has been a very important and positive session, really, for European bourses. At this stage, we have, you can see them on your screen, we have all of the major bourses in the green at this stage. But in all fairness, when you look at the benchmark, a very important day. Let me just share some of the numbers with you. All in all, though, we are on track to see a record high happening today. We are seeing a lot of momentum for real estate as well as technology stocks. So let's see whether the mood could actually change after this ECB rate decision. But before we hear from the ECB, let's get over to Frankfurt for Annette. She is joining us with more. Annette, we are all expecting a 25 basis point cut at today's meeting. But beyond that, what are the markets looking at? What is the most important element from today's meeting?
But probably if you look at the narrative the ECB will display today, the most important thing is how they look at sticky service price inflation versus the rather grim economic picture, and whether they think that economic grim picture will actually have a reinforcing disinflationary trend in itself. I guess this is the crucial message which could come out of this press conference, because the other parameters are not under the control of the ECB, whether there will be fiercer trade tensions between the EU and the US, highly likely. That could lead also to a more disinflationary pressure. And of course, the energy prices, that's what Christine Lagarde was referring to in Karen's interview, could also put more downward pressure on inflation. So we could well be in a scenario where we see more rate cuts than the 2 which are kind of priced into the market until the summer break, because clearly with that economic a picture with like no real silver lining on the horizon for improvement, that could be a major issue for the ECB. We have various economies in the euro area in contraction, and of course the voices out of these economies like Germany but also France are quite loud that the current interest rate level is too high to actually support economic activity. So remains to be seen, but I think that is the crucial issues during the upcoming press conference.
And we shall wait and see what will be the communication. Thank you for the reporting. I'm sure we'll have a chance to speak again later, Annette. In the meantime, and as I highlighted earlier, it's not just about the ECB. Markets are also digesting the comment from the Federal Reserve yesterday. Wait and see. That was the message from Jerome Powell, who spoke after the Fed pressed pause in its latest policy decision, keeping its target rate unchanged at 4.25 to 4.5%. Powell said the central bank needs to see the impact of President Trump's policy changes before it can even begin to make a plausible assessment on what the implications for the economy will be. In a move reflecting uncertainty over the policy horizon, the FOMC cut a line from its post-meeting statement that had previously said it has made progress toward its 2% inflation goal. I'm pleased to say that to put all of this into context, we are joined now by Fabio Balboni, Senior European Economist at HSBC. Fabio, great to see you. I would like to first and foremost discuss the ECB before we look at the Fed here. My colleague Annette was just highlighting there how one of the uncertainties for the central bank is what's going to happen to services inflation. What are you forecasting from that point of view? How much of a headache do you think this is going to be for the ECB going forward?
I mean, there's a significant amount of uncertainty when it comes to services. But in general, we're looking for a quite sharp moderation of services inflation. It was at 4% in December. We think it could be at 3% by mid-next year. So that should happen relatively quickly. For instance, this morning, we had a small downside surprise already on core inflation in Spain. Of course, we don't have the Eurozone print. So we think that overall, the ECB should be relatively comfortable with the way services prices are going to evolve over the course of the year. And one reason is because wages are being very well behaved. The ECB has been publishing a new forward-looking negotiating wages tracker, which shows that wages, the risk of second round effect of inflation on wages is pretty much gone. So I think the ECB would be quite comfortable with the services inflation outlook, notwithstanding some of the pressure that might come from energy as well as weaker euro, of course.
Of course, and Christine Lagarde did mention energy prices as well recently. But what I would like to understand is also getting a quick reaction from you in terms of the latest GDP figures that we obtained for the Eurozone. Missing expectations on the quarter and on the year. Is this a moment where we need to be seriously concerned about the growth outlook for the Eurozone?
Well, certainly, we have seen a shift in focus by the ECB, starting already from December, from inflation concerns towards growth. And certainly the print this morning will only reaffirm these increasing concerns around growth. The ECB forecast looks too high at the moment for 2025 at 1.1%. So they won't revise it today, but they will have to revise it down in March. And plus, you've got a series of risks, of course, coming from possible US tariff that could provide further downside risk for growth. So certainly, I think the message from today's GDP is a dovish one. It reinforces our view that the ECB will cut at least through to April every consecutive meeting. But there is one important question mark, however, that the ECB will have to answer. How much of the current GDP weakness is cyclical, and to what extent the ECB can do something about it, or it is structural. And if it's the latter, there isn't a huge amount the ECB can do. So I wouldn't be expecting the ECB to be chasing ever lower rates either.
Of course, there's other consequences as well. Fabio, I also would like to get your thoughts on what we heard from the Fed. But before we get there, let me show you this comment from Jerome Powell speaking yesterday.
The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work. And that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact.
And of course, Fabio, Jerome Powell was addressing the concerns off the back of the comment from Donald Trump that he actually knows more about monetary policy, that the rates should be even lower. To what extent is there a risk here of the pressure on the Fed having spillover effects into the ECB as well?
Well, I mean, there is one obvious challenge, which is, of course, the exchange rate. As I was saying before, like the weakening of the euro, we expect further weakening over the course of the year that could mean more imported inflation into the eurozone. So there is an obvious spillover, but there is also something that is less obvious. And, you know, the market has been taking a one-to-one, transferring one-to-one US monetary policy into the eurozone, while we know that the growth outlook is completely different. So we have to be careful how much we transfer from one to the other. So we are still looking for the Fed to cut rates in the second half of this year, because we think that the labor market in particular could slow down enough for them to do a few rate cut. But certainly it is a more hawkish environment for the Fed than it is for the ECB, at least in the near term.
Right, and just perhaps for a reference, I did mention this earlier, but looking at euro-dollar at this stage, we are seeing the euro marginally lower against the USD. Let's see what sort of moves we'll get in the currency space. In the meantime, thank you for your time today. Fabio Alboni, Senior European Economist at HSBC. Now, we are just minutes away, really, from that all-important announcement from the ECB. We'll bring you that decision after this break. Welcome back. We are now just minutes away from that all-important ECB rate decision. So let's get a final check ahead of that on what's happening across markets, starting with euro-dollar. We have seen a little bit of pressure for the euro against the USD, which is marginally below the flat line, really, when it comes to that trade at 1.04. Overall, though, worth keeping in mind that the latest inflation print for the Eurozone actually rose in the month of December to 2.4%. This is important to keep in mind because overall, the narrative from the ECB has been very much that inflation has come down from the peaks that we have seen a while ago. But at the same time, though, the recent uptick, is there some sort of source of concern for the central bank there? I'm sure there will be questions about that as well for Christine Lagarde during the press conference. Thinking about the bond market at this stage, if we take a look at the yields on the 10-year papers, we are seeing lower moves across the board for all of these European bond yields. Indeed, also highlighting that we are in a different stage than we were a couple of weeks ago when there was a bit of turmoil in the bond market. We have seemed to have recovered from that, at least for the time being. And in terms of the equity session thus far, it has been quite strong, really, for European stocks. We are seeing quite a lot of upside, particularly for real estate names as well as tech names too. And I'm conscious that we're only 8 seconds away really from the decision, so I'll keep a close eye on this rate announcement from the ECB. Worth recapping that the ECB deposit rate at this stage is at 2.75%. Markets, however, expecting a 25%. And we have the decision, and it's a no change in policy from the ECB. The deposit rate is staying at 2.25%. There is, however, I apologize, a 25 basis point cut. I was looking at the forecast here. There is indeed a cut of 25 basis point from the ECB, so bringing the deposit rate to 2.75% from the 3% that they had originally in place. So to recap, we are getting a 25 basis point cut from the ECB today, in line with expectations. And indeed, it is important to keep in mind the context here. There's a growing conversation around perhaps the shift in focus from the ECB, perhaps paying a little more attention to the growth picture in the Eurozone as we are seeing inflation coming down. And indeed, worth recapping, because I was looking at the wrong number, I was looking at the forecast. We got a 25 basis point cut from the ECB, the deposit rate at this stage sticking, bringing it down to 2.75%. So, of course, important day, and Annette has been tracking the decision as well. Annette, no change in terms of what analysts were expecting going into this meeting. I've corrected myself there because I'm conscious that I was looking at the wrong number to start with. But indeed, we obtained a 25 basis point cut from the ECB. Just explain for us how difficult the job of the ECB is at the start of this new year, given all of the uncertainty as well from a macroeconomic point of view.
Well, I think for now, I have to say it's not so difficult because clearly there is a disinflationary picture. We see that in the projections as well. The ECB is well expecting that inflation is coming back to that target. And at the same time, they have an economy which is actually less buoyant than previously expected. So it's a clear picture for rate cuts. It's a very different scenario than in the United States, and that's what the ECB is doing now. They are saying that financing conditions, which of course are crucial for economic activity, are easing, but they continue to be tight because monetary policy is working its way through the system, and past rate hikes are still spreading across the financial system. That's why we see that dual movement, so to say. We have effects already taking place from the rate cuts, but we're still seeing the last effects also from the last round of rate hike. Staff now expecting a slower economic recovery. I think that's important as well for the assessment. They see economic growth by 0.7% last year, 1.1 just for this year, and then 1.4 for 2026. I spare you 2027, but that picture tells you that the economy of the euro area is not very vibrant, and that rather support is needed also from the ECB. That's why most likely, perhaps we see during the press conference more hawkish comments as well from Christine Lagarde, given that the economic picture looks worse than previously expected. Perhaps we see more room even for rate cuts going forward, because clearly the disinflationary trend, as I said again, that is something the ECB doesn't question anymore, despite the fact that we still have domestic inflation, what they call more or less the inflation stemming from service sector and also from the wages in the euro area is still elevated and too high, but it shows signs of coming back. So clearly, as I said, the 25 basis points today were really baked in, well telegraphed from the ECB. The key question is whether they will move on about every single meeting. Currently, the market believes one rate cut each quarter now going forward.
It's very interesting how they're also sticking to some of the previous commitments, stating that, of course, they will follow a data-dependent approach, taking meeting decisions, and at the same time, that statement of not pre-committing to a particular rate path. So even though we are seeing pressures here on the outlook, particularly on the growth outlook, they're very much keeping that flexibility, Annette. So that's what I would like to focus next, really. They have adopted this flexibility approach for a while now. Are we in a position to actually see the ECB changing that approach in the near future, or the uncertainty that they have to deal with is just so high that this is what we're going to get from the central bank going forward?
Yes, I think there is no change to that data-dependent approach, and it doesn't really mean one data set. It's not only inflation. They look at a whole variety of parameters. It's more like a bunch of data. That's what Christine Lagarde has said over and over again. And of course, they want to make their mind up at each and every single meeting, because it's 6 weeks in between, at least between the ones which have a press conference. They meet every 3 weeks. And a lot can happen in that world. If there were a round of tariffs levied on euro area US trade, that would have an immediate effect, most likely on inflation expectations, and the ECB would have to react to that. Also, geopolitical tensions could rise or could abate, and that might also have an effect on, for example, supply chain inflationary pressure. So I guess, yes, to answer your question, we won't see a change to that commitment from the ECB that it's data dependent and flexible, but that doesn't say that they change course or U-turn all of the sudden and give us a rate hike at the next meeting, because clearly, again, the disinflationary process is well on track and the economic picture looks like more rate cuts are needed.
So let's see what they will do going forward, and of course what they will say in the press conference later today. We'll let you get ready for the press conference. Thank you, Annette. In the meantime, I want to discuss some of the currency moves really with Kit Jukes, head of FX strategy at SocGen. Kit, great to have the chance to speak with you. So no change really in terms of what we were expecting going to this rate decision, getting a 25 basis point cut. But my question to you really is on the outlook for the euro going forward against the US dollar. The ECB is keeping the door open to potential further rate cuts down the line. But what is that going to mean for the currency pair, given the pressures that we are witnessing stateside?
I think in terms of what the ECB does, I mean, we saw yesterday with the Federal Reserve that that they can shuffle around a bit of their language, and we pay quite a lot of attention because we want to know what they're going to do with rates. We almost take growth for granted in the States and focus on the rate outlook sort of with that. Whereas in Europe, whether they do or don't cut rates, the problem is they don't have enough growth. So, I could balk at the number of rate cuts that are priced in, but it wouldn't make a lot of difference to my concerns about the currency. Europe needs more growth. That divide between Europe and the United States, the divide between everybody in the United States is too wide. So what could come along to improve the growth outlook? Well, end of the war in Ukraine would be fantastic at every level that I can imagine. It would send the euro up. Failing that, we're getting slightly better data coming out at the moment. That makes me think the euro's got a bit of a base, that I'll probably see the euro trade in a narrow range for most of this year, which makes me feel a bit miserable, but that we're probably not going to break down towards those 2022 lows at 95 that parity will hold. And the ECB just has to keep on doing its best. But, the big story for the euro is that European investors are throwing all of their money, all of their investments at the United States. We need to find investment opportunities for Europeans in Europe to keep the surpluses here, and then the euro will go up quite quickly. But that simply isn't happening at the moment.
We did get the announcement from the European Commission yesterday on how to be more competitive. Do you think that is going to help at all the growth outlook for the Eurozone going forward? Or is this likely to just take perhaps too long in order to see this revival in growth for the Eurozone?
It'll take a long time. I mean, there's part of me that thinks that we need to deregulate a lot of things. But if we choose a lot of regulations that, say, the United States doesn't choose, we continue to get slower growth. So I think we should welcome anything that anybody from the EU Commission onwards, downwards, sideways, wants to do that boosts investment in Europe and growth. We don't have a shortage of private sector capital. We've got, the world's biggest foreign investor in the world is Germany. That, if we could give them projects at home, there's plenty to do. But so anything like that starts me feeling better about the Eurozone. At the moment, I'm just in a position where I look and say, I don't think the euro should fall much further. There's an enormous amount of negative sentiment priced in. The biggest catalyst I could see in the near term would be an end to the war in Ukraine, and we'd welcome that. Shy of that, 103, 104, 105, 106, 105, we're likely to bobble around in this range unless something happens.
And Kit, a quick question on where you think the biggest pressure is actually coming from. When you think about Germany or when you think about France, which one is actually the biggest headache for the bloc?
I think they're both a big headache for the bloc because what they're doing is they're unable to make policy decisions, drive them through and change the current slow growth reality. So, they're both big enough economies that they could help. If you could stabilize Germany and France and get a more pro-growth outlook coming from them, perhaps a change in fiscal policy and perhaps a change in some of the rules around that, then we would be able to shine a brighter light on, for example, the stronger growth we've been seeing in Spain, in some of the other countries around the Eurozone, and say, actually, we're all too negative about the outlook for Europe. It's not that bad. When we can say it's not that bad, then the currency will be quite a lot stronger.
Let's see what will happen. I like the comment on, though, it's not that bad, but of course, there's a lot of things to keep in mind. Thank you for your time today. Kit Jukes, head of FX strategy at SocGen. Stay tuned because we'll have more reaction to the ECB's latest decision after the break, and we'll bring you Christine Lagarde's press conference live at 14:45 CET. Welcome back to Decision Time. I'm Sylvia Amaro. We just heard from the ECB in terms of their latest rate decision. No surprise for the markets here. They announced a 25 basis point cut, the first of this new year. At the same time, the ECB also saying that the disinflation process is well on track. So thus far, they are seeing progress in terms of moving towards their target of achieving an inflation of 2%. At the same time, though, they're also quite confident about the outlook for inflation here. They're saying inflation has continued to develop broadly in line with their projections, and it is set to return to the 2% medium-term target in the course of this year. So, of course, let's see what the incoming data is going to tell us. But thus far, the ECB quite happy about the progress. But of course, still more tasks surely to come. They're not yet saying that it is the end in this fight against inflation. In the meantime, U.S. initial jobless claims data is about to hit the wire. So let's cross over to our U.S. colleagues for that.
4.492, the 2-year at 4.191. And as I mentioned, Mr. Santelli is, of course, standing by at the CME in Chicago. I know you've got the numbers in about 15 seconds.
Yeah, about 15 seconds. You know, what's noteworthy here is today's a big day. After the Fed meeting where we did nothing in terms of we had a pause, ECB lowered. We're flirting with 4.5 and a 10 and 4 3/4 on a 30, and the data is hitting the wires. Let's start out with initial jobless claims, shall we? 207,000, well below the mark of 225,000 that we were looking at. 207,000 will be the smallest initial jobless claims number since the first week of the year when it was 203,000, and that was the lowest level going all the way back to February of 24. If we look at continuing claims, very fascinating. Continuing claims, 1,858,000. That's not a 34th consecutive month above 1.8 million, and something has changed. In the rearview mirror, we actually went from 1,899,000 to 1.9 million. Now, this is interesting. We haven't had a 1.9 million handle in 38 months on continuing claims. So this is a big deal. We want to monitor that, and we want to look now at our first look, as Andrew pointed out, on GDP for the fourth quarter, and the number comes in on the light side, 2.3%. We're looking for something a bit over 2.5%, sequentially under the 3.1%, which was rather robust last quarter. 2.3 would be the smallest since the first quarter of 24 when it was at 1.6. If we look at consumption, a big jump here. This is a strong number, 4.2%. That's a full percent more than we were expecting. That's 0.5% more than the rearview mirror at 3.7. 4.2 is the best since the first quarter of 23. That is something that's going to potentially push rates up a bit and argue against a slowing economy. On the price index, comes in on the light side. 2.2, we're expecting 2.5%. Now, even though it's better on an expectations level, it's still sequentially higher than the 1.9% in the rearview mirror. 2.2% equals the highest level of inflation in this regard since the second quarter of 24. And if we look at the core price index, that comes in at 2.5, exactly as expected. But once again, that's warmer than the rearview mirror at 2.2%. 2.5 would be the warmest, just like our last number there since the second quarter of last year. So we want to pay second quarter of this 2024. Now, as we look at all the data, the market really has to divine a lot of information here. Many look at expectations on anything that measures inflation, and usually on the day of trade, based on positioning, that ends up being more important. But in the macro view, and this is why many have gotten the Fed wrong, if you take a step back and just look at the numbers for what they are, they're still running a bit on the hot side with respect to pricing, and we're seeing some good numbers on initial claims. Maybe we're starting to run out of gas on the superlative performance on continuing claims. And as I said, 4.5%, well, we haven't closed below 4.5% since the 12th of December. And if you look at a 2-year, it closed at current levels would be the lowest yield close since about the second week of December. And finally, it's 4.5% in a 10. It's 4 3/4 on a 30. We haven't closed below that since the 20th of December. Andrew, back to you.
Okay, Rick, thank you for all of that and all of that analysis.
And that was U.S. jobless claims data as well as the latest GDP figures as well from the United States. Let's turn back our attention to the ECB. I want to show you how we're faring across the markets after the rate decision from the ECB. We continue to see similar levels of pressure for the euro as to those that we had seen before the rate decision, so not huge amounts of pressure ultimately. Also, what we obtained was in line with what analysts were expecting and the markets had priced in, a 25 basis point cut. At this stage, indeed, we have the euro tracking at 1.04 against the US dollar. It is a very busy day, not just on central bank policy decisions, but also on the data front. Of course, we were just showing you there some of the latest GDP figures from the United States and the initial jobless claims. But when you think about the numbers that we obtained here in Europe today, Eurozone, the economy actually flatlined in the fourth quarter, and it missed expectations in terms of what was priced in. So we are starting to see on the data front some of these pressures that everyone is discussing in terms of the growth outlook for the Eurozone and more broadly the European Union as well. And that is, of course, also a headache for the ECB that has to monitor what's happening on the growth front, at the same time on the inflation front too. But ultimately, when you look at their assessment today, they're very much highlighting that they still think the economy is facing headwinds, but rising real incomes and the gradually fading effects of restrictive monetary policy should support a pickup in activity. Of course, the incoming data will tell us whether that's going to be the case. Let me show you the bond market too, how we're faring in terms of 10-year bond yields. We continue to see lower moves across this space. Once again, the rate decision was not a surprise for the markets. And when you think about the outlook for European bond yields, it's also important to think about the message from the Fed, which yesterday decided to basically be on pause, press pause for the timing on their rate decisions. One of our guests was highlighting how that could also bring pressures for the euro and against the US dollar. Of course, a lot in the minds of investors. Let's digest some of that with our next guest. Ben Emmons, founder of Fed Watch Advisors, is joining us now. Ben, great to have the chance to speak with you. So we're not seeing basically a change in terms of expectations from the ECB, but their message today seems to keep the door open to further rate cuts. What do you think we'll have in store from the ECB going forward, and how many rate cuts do you think they will deliver this year?
As you say, the ECB does have some room to cut rates, maybe compared to the Fed that seems to be closer to the neutral rate and have perhaps less room. Why there is that interest rate difference developing, why the euro is weaker. And I think based on the statement, though, is that it's interesting they acknowledge that the disinflation is on track, but they still see a lot of tightening in the system, so they still have restrictive policy. So I think that's their room, right? If disinflation stays on track, and yet they have restrictive policy, they could cut more. I think this is why the market is pricing in a path for the ECB with more cuts, about 95 basis points roughly for this year remaining, compared to the Fed about 50. So I think that's right. I think you could see the sequential sort of cuts every quarter, really driven by their forecast on data. I think that they're going to tie more into that to keep themselves data dependent by giving them time to assess the data. I think this is then becoming very predictable, like we've had in the past. So these yields decline we're seeing in Europe today is not so aggressive for that reason. I think you're going to see some ranging in yields from here.
So explain to us the range here, and what are you expecting from a bond market perspective? Because obviously, as we are watching now the ECB announcing another rate cut, the Fed pressed pause yesterday. So what does that mean for the bond market? Also at a time when we started this year seeing a lot of volatility in that part of the market.
Yeah, I think we can expect that the 10-year bond yield, let's take that as the benchmark, probably ranges anywhere between 2% and 2.3, roughly where we are now today. Whereas the Fed, the 10-year, will probably be more like 4.5-ish or about where we're now to 5%, because there was a reaction yesterday to the FOMC meeting, right, from the president. And it was, to me, really much about an economic calendar of like, I'm going to drive growth, bring energy prices down. It's all lifting growth. So it actually gives you an upward bias to rates in that sense and yields. Whereas in the Eurozone, we're dealing with weakness. We're dealing with disinflation that stays on track because of the weakness. So the range is not only lower, but it's also lower rates. So I think the interest rate differential between bonds and treasuries may actually widen as a result. If we're going to go to the lower end of the range of 2% on bonds and the upper end of treasuries, then we're going to get 300 basis points of interest rate differential. That may be in the cards in the future.
Also talk to us about the outlook for energy prices. If you go back to the ECB, and of course Christine Lagarde has been highlighting in recent weeks how energy was basically what they are monitoring the most, really, and how that could actually provide a relief for inflation as well going forward. What are you expecting from that point of view, really?
Yeah, it's an interesting dynamic playing out because we're dealing actually with, on the one hand, still an oil market that may end up in some sort of surplus, whereas we're having obviously a lot of initiatives in the US side to try to increase the oil supply even more against a weaker demand backdrop coming from Europe and also to an extent from China. And net, we're also having let's say the Ukraine war there, but not has as much effect anymore on gas prices as it used to be. So I think for the ECB, for Europe, there's a favorable conditions for lower inflation from here, particularly headline inflation. I think why these ECB sees this disinflation staying on track because of energy. Whereas in the case of the US, it's a little different story. You have much more stickier services inflation that's staying around longer than people had anticipated. So that's not the case in Europe. So I think from an energy perspective, I don't know how low oil prices will go from here. That is dynamic, I think, but it is the bias to lower, particularly driven by supply. So favorable conditions, I think, for inflation in Europe.
Where do you think the momentum could come from a growth perspective for the Eurozone? Obviously, this now seems to be the big focus when you think about monetary policy as well as fiscal policy. But can that actually take place? And if so, where?
That's where the limits are, I think, because we do deal with obviously budget limits and sort of the idea of the Stability and Growth Pact of 3% deficits. And we have smaller deficits in the Eurozone. So I'm not sure if the fiscal space is so large. It comes more from the manufacturing that could have some rebound because of the weakness of the euro. Maybe on the back of also that if the US sees some more stronger performance into the first half, that Eurozone manufacturing activity actually could be lifted. And against a weaker euro driven by this stance of the ECB lowering rates, and perhaps some fear about the tariff impact too, which is to be seen. We don't know that exactly. So I think it's a combination of those, which gives you some momentum for Eurozone coming.
Let's see whether that will be enough to propel the economy going forward. Ben, we appreciate your time today. Ben Emmons, the founder of FedWatch Advisors. And for the latest commentary and reaction for the ECB's rate decision, head over to our live blog at cnbc.com. Stay tuned. We'll bring you Christine Lagarde's press conference after this break. Welcome back to Decision Time. We're now awaiting the ECB president, Christine Lagarde, who is due to deliver her press conference shortly. We'll keep an eye on what's happening in Frankfurt. In the meantime, I want to take you back to the session in terms of currency markets after the announcement from the ECB that they're cutting rates by 25 basis points. And perhaps even more importantly, so the fact that they kept the door open to potentially cutting rates further going forward. At this stage, we are basically flat in the pair euro against the US dollar at 1.04. Of course, one of the open questions here is what Donald Trump is going to do in terms of tariffs on the European economies. Let's see whether he's going to announce those tariffs, how big that's going to be. And of course, that could have implications for the currency trade. But for the time being, off the back of this decision, which was in line with what analysts were expecting, we are flat on this pair. I want to take you to the bond market too and check what's happening on that front. Going into this rate decision, we were seeing European bond yields moving lower, and that momentum has continued really. So we are at a total different mood compared to what we had a couple of weeks back at the start of the new year, where we saw volatility in the bond market. I want to take you to the benchmark, the yield on the 10-year bond tracking lower at about 2.5% at this stage. In terms of European markets, let me show you that as well, because it has been such a strong session ultimately for European equities today, in particular for real estate and for tech names too. Before we get that, I want to show you the different bourses. As you can see on your screen, we are moving higher across the board. We are actually on track to see strong gains for the Stoxx 600 by the end of the trading day. Let's see whether that's going to continue. But indeed, we are at a different stage compared to what we had even a couple of days ago, where we saw the implications on European equities from the deep-seek saga and the outlook here for AI and big tech as well, that also had downward pressure for European equities too. But that narrative has changed as we have evolved throughout this week. Of course, investors also keeping an eye on the incoming data. With that in mind, I just want to briefly mention that when you think about the latest GDP figures for the Eurozone, they actually missed expectations slightly. So that growth pressure, I should say, for the Eurozone is very much getting real, really, for when you assess what's going on the block. Let me take you to the European banking sector. Of course, this is a sector that is very sensitive to changes to monetary policy. Thinking about the BNP Paribas, it is the only one at this stage from the names we have on the screen that are moving higher. We're up almost 1% for BNP Paribas. Deutsche Bank, Commerzbank and UniCredit actually moving lower at this stage. Let me take you to the real estate names, because as I highlighted earlier, we did see a bit of momentum for the sector going into today's rate decision from the ECB. The whole sector at this stage, the Euro Stoxx real estate, is up almost 1.7% at this stage. Of course, the fact that we are seeing announcements of rate cuts is supportive, really, for the outlook of real estate names. But let's see what's going to happen here as well. One of the open questions as well, when you think about the outlook for the ECB, is what incoming data will tell us about inflation. The overall message from the ECB today is that thus far, inflation has moved in the right direction. It has actually come down over the past year or so. But when you think about the numbers for December, we saw a little bit of an uptick, really, and that headline figure was 2.4%. I'm sure there will be questions about the inflation outlook during the press conference. Christine Lagarde is just getting ready at the stage to address the questions from journalists. Another question here, though, is what the ECB is going to, how the ECB is going to assess all of the policy changes from a European Union perspective. Yesterday, we had the Commission announcing a set of competitiveness measures, exactly because there's a realization in the bloc that they need to do more if they want to remain relevant at the global scene. Now we're just keeping an eye on what's happening in Frankfurt. They took those traditional pictures ahead of the press conference. So let's cross over to Frankfurt and understand what is the commentary from Christine Lagarde after the ECB announced a 25 basis point cut.
And my name is Wolfgang Preußel. We have also journalists participating via video link. As always, in case they ask questions, please connect your camera and unmute. And with that, I hand over to President Lagarde, please.
Thank you very much. Good afternoon to all of you. The Vice President and I welcome you to our press conference. The Governing Council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. The disinflation process is well on track. Inflation has continued to develop broadly in line with the staff projections and is set to return to our 2% medium-term target in the course of this year. Most measures of underlying inflation suggest that inflation will settle at around our target on a sustained basis. Domestic inflation remains high, mostly because wages and prices in certain sectors are still adjusting to the past inflation surge with a substantial delay. But wage growth is moderating, as expected, and profits are partially buffering the impact on inflation. Our recent interest rate cuts are gradually making new borrowing less expensive for firms and households. At the same time, financing conditions continue to be tight, also because our monetary policy remains restrictive and past interest rate hikes are still transmitting to the stock of credit, with some maturing loans being rolled over at higher rates. The economy is still facing headwinds, but rising real incomes and the gradually fading effects of restrictive monetary policy should support a pickup in demand over time. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity. The economy stagnated in the fourth quarter, according to Eurostat's preliminary flash estimate. It is set to remain weak in the near term. Surveys indicate that manufacturing continues to contract, while services activity is expanding. Consumer confidence is fragile, and households have not yet drawn sufficient encouragement from rising real incomes to significantly increase their spending. Nevertheless, the conditions for a recovery remain in place. While the labor market has softened over the recent months, it continues to be robust, with the unemployment rate staying low at 6.3% in December. A solid job market and higher incomes should strengthen consumer confidence and allow spending to rise. More affordable credit should also boost consumption and investment over time. Provided trade tensions do not escalate, exports should support the recovery as global demand rises. Fiscal and structural policies should make the economy more productive, competitive, and resilient. We welcome the European Commission's Competitiveness Compass, which provides a concrete roadmap for action. It is crucial to follow up with further concrete and ambitious structural policies on Mario Draghi's proposals for enhancing European competitiveness and on Enrico Letta's proposals for empowering the single market. Governments should implement their commitments under the EU's economic governance framework fully and without delay. This will help bring down budget deficits and debt ratios on a sustained basis while prioritizing growth-enhancing reforms and investment. Looking at inflation, annual inflation increased to 2.4% in December, up from 2.2% in November. As in the previous months, the increase was expected and primarily reflected past sharp drops in energy prices falling out of the calculation. Along with a month-on-month increase in December, this led energy prices slightly higher on an annual basis after 4 consecutive declines. Food price inflation edged down to 2.6% and goods inflation to 0.5%. Services inflation edged up to 4%. Most underlying indicators have been developing in line with the sustained return of inflation to our medium-term target. Domestic inflation, which closely tracks services inflation, has remained high as wages and some services prices are still adjusting to the past inflation surge with a substantial delay. At the same time, recent signals point to continued moderation in wage pressures and to the buffering role of profits. We expect inflation to fluctuate around its current level in the near term. It should then settle sustainably at around the 2% medium-term target. Easing labor cost pressures and the continuing impact of our past monetary policy tightening on consumer prices should help this process. While market-based indicators of inflation compensation have largely reversed the declines observed in the autumn, most measures of longer-term inflation expectations continue to stand at around 2%. Looking at the risk assessment now. The risks to economic growth remain tilted to the downside. Greater friction in global trade could weigh on euro area growth by dampening exports and weakening the global economy. Lower confidence could prevent consumption and investment from recovering as fast as expected. This could be amplified by geopolitical risks, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which could disrupt energy supplies and further weigh on global trade. Growth could also be lower if the lagged effects of monetary policy tightening last longer than expected. It could be higher if easier financing conditions and falling inflation allow domestic consumption and investment to rebound faster. Inflation could turn out higher if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. By contrast, inflation may surprise on the downside if low confidence and concerns about geopolitical events prevent consumption and investment from recovering as fast as expected, if monetary policy dampens demand by more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Greater friction in global trade would make the euro area inflation outlook more uncertain. Looking at the financial and monetary conditions now. Market interest rates in the euro area have risen since our December meeting. partly mirroring higher rates in global financial markets. While financing conditions remain tight, our interest rate cuts are gradually making it less expensive for firms and households to borrow. The average interest rate on new loans to firms declined to 4.5% in November, while the cost of issuing market-based debt remained at 3.6%. The average rate on new mortgages edged down to 3.5%. Growth in bank lending to firms rose to 1.5% in December, up from 1% in November, amid a strong monthly flow. Growth in debt securities issued by firms moderated to 3.2% in annual terms. Mortgage lending continued to rise gradually, but remained muted overall, with an annual growth rate of 1.1%. Credit standards for business loans tightened again in the fourth quarter of 24, having broadly stabilized over the previous 4 quarters, as reported in our latest bank lending survey. The renewed tightening mainly reflected banks becoming more concerned about the risks faced by their customers and less willing to take on risks themselves. Demand for loans by firms increased slightly in the fourth quarter, but remained weak overall. Credit standards for mortgages were broadly unchanged after 3 quarters of easing, while the demand for mortgages again increased strongly, mainly because of more attractive interest rates. In conclusion, the Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions. Thank you.
First question goes to Balazs Koranyi of Reuters. Balazs, please.
Good afternoon. Thank you for taking my questions. First question is about the future. Where do we go from here? Are you still confident about the direction? Your fellow board member, Isabel Schnabel, said we're getting closer and closer to the point where you need to have a discussion about how much further rates can come down. Did you start having the discussion today, and what's your own view on this point? Second is about the neutral rate. Speaking in Davos, you gave a slightly different range for your neutral rate estimate than in the press conference here. Why did you change the estimate? Why did you lower the midpoint? What is the significance, or if there is a significance, of this change?
Thank you so much for your 2 questions. First of all, I just want to remind you that by lowering by 25 basis points today our 3 interest rates, and particularly the DFR, we have now cut down by 125 basis points relative to the high level where we were. Number 2, there was no discussion as to whether this decision was appropriate or not. It was a unanimous decision. So all governors supported the decision that was articulated by Philip Lane this morning of cutting by 25%. You will have seen in the monetary policy statement clearly stated that at this point in time, we are still in restrictive territory. And we have not had a discussion, because it would be premature at this point in time, about the point where we have to stop. We know the direction of travel. You've mentioned it in your question. And this is the direction that we will take, at which pace, with what sequence, what magnitude, will be informed by the data that we will collect in the coming weeks and months, and by the analysis that our staff will conduct. We are lucky that for our next monetary policy meeting in March, we will receive a projection prepared by staff, which will be informed by the economic environment as it unfolds, and we will have, in the meantime, 2 additional readings on inflation. Those are data points, granted, but a series of inflation readings are informing those decisions. On the on R-star, natural interest rate, you will be pleased to see in 8 days, on February the 7th, a publication by staff on the revision of the natural interest rate. And, you know, this is not something that we have discussed. As you know, it's a range, and it's a range that has, that does not give a guidelines or a destination. It's an indication, and it's in many ways a conceptual principle that is elaborated by a number of models, and that's what staff will publish and will comment upon. So you'll have plenty of it to elaborate upon.
The next question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much. I have a question on the economic outlook. You're saying that you're expecting that exports will contribute positively to economic recovery or activity, but if you look at the uncertainties in that world, how much do you think actually this is something which is realistic, given the slowness in China, given the Trump administration? And did you, my second question is whether, given that bleak economic picture and also the disinflationary trend and these restrictive monetary policy stance, why didn't you discuss 50 basis points cut? Thank you.
Well, I can reassure you right away, we did not even utter the 2 numbers 50. So 50 was not in the debate at all. And as I said, there was rallied support at unanimously by all members of the Governing Council for 25 basis points. Your question on exports, it's an interesting one. We took the precaution in the monetary policy statement to refer to export as a potential engine for growth. Not the main one, but an additional one. And we took the precaution to say, if I recall, provided that there is no trade or additional trade friction, something along those lines. So that's in the economic activity paragraph. And then we talk about exports yet again in the risk section. And we clearly analyze the trade environment, the framework within which trade takes place, and the uncertainty associated with it as a potential risk. But obviously, there are rumors, there are statements, there are assumptions, but we don't have anything that is, clear, tangible, and can be inserted into the analytical work that staff does. So we will be looking very carefully at the numbers that come in, the information that sort of consolidates, and obviously staff will incorporate all that in the work that they are going to do for the March projections. I'm not sure that there will be, by March, enough certainty to actually be very confident. I think we will still be plagued by uncertainty in that respect, and there will be more to come. But as it comes, we will be taking that into account.
And the next question goes to Mark Scheuers of Bloomberg. Mark, please.
Yes, thanks a lot. The first one is on inflation. Your confidence in reaching the 2% target is very much based on the expectation that wage growth and services inflation will slow down significantly. That hasn't materialized yet. Services inflation is still around 4%. At what point in time do you need to see hard evidence in a slowdown in services inflation to continue cutting rates, let's say, beyond March? And the second one on a completely different topic. Your Czech counterpart yesterday said that his institution will assess including Bitcoin into foreign currency reserves. And US President Trump has backed the idea of a national strategic Bitcoin reserve. What do you think about such ideas? Is that something the ECB is looking into? Thanks.
Well, thank you very much for your two questions. On yes, we are confident that inflation will reach our target in the course of 25, and that's 2% medium term, sustainably so. And you are right that there is one particular item which is still resisting. The others are moving down. You know, when you look at goods, when you look at non-energy industrial goods, when you look at subsets of all that, it's definitely moving down. And I have said in previous press conference that when goods are going down to 0.5, we're not going to expect that services will be at 2, because we would be clearly undershooting. But services, and in particular, if we look at the various underlying measurements, the domestic one, the one that strips out anything that has to do with exports, is still resisting. And has actually gone up a little bit, because on services, we were at 3.9, we moved to 4. We're not data point dependent, but we look carefully at services. And we know that, you know, those services are largely labor intensive, with or without contact. We used to have that distinction in the COVID time. We have less of it at the moment, but it is largely wage, labor intensive, and as a result, wage sensitive. We try to measure and to understand wages as much as possible, because it is so relevant for services. And all the indicators that we have at the moment are heading downward and are giving us, are confirming our confidence that wages in 25 will be going down. Whether you look at compensation per employee, which is quite a useful and relevant indicator, whether you look at the wage tracker that we have, whether we look at Indeed, whether we look at the ratios of vacancy to unemployment, all of those indicators are heading in the same direction. We're not celebrating that, but we are taking note and acknowledging the impact that it will have on services. Some of you will remember that I've also, and we have focused on the distinction between the newcomers and the latecomers. We took, for instance, a particular review and deep, tried to have a better and deep understanding of those latecomers that, you know, waited for a period of time until they decided to hike prices. That is clearly the case for insurance companies, for instance, that do not increase their prices on a monthly or quarterly basis, but they generally wait until the expiry of a contract and then they hike prices. So we will be very attentive to how the latecomers, which did hike prices in January to March 24, whether this process under which they caught up with inflation is going to be duplicated this year again. We don't think so. And, you know, we do a corporate telephone survey, the result of which you will see tomorrow, because we publish tomorrow. But our understanding from the corporate telephone survey as well, because we ask them, you know, how do you see negotiations taking place? And when do you expect increases? All of that is heading in that direction. So it gives us the confidence that wages are on their way down, and therefore will impact the price of services, and that we will see you know, a declining movement in the course of 25. We don't expect, I think we say in the monetary policy statement that in the coming, the next couple of readings will still be resistant, if you will, largely because of base effects on energy prices. But from there on, we see this declining path in the course of 25. But once again, we don't look at one data point or one, it's not just compensation per employee. It's not just negotiated wages. It's the combination of it all, because it's a complex matter, depending on member states, depending on collective bargaining agreement and their renewal, all of that. On this matter that you referred to, and whether reserves of central bank should or could include bitcoins, I think there is a view around the table of the Governing Council, and most likely the General Council as well, that reserves have to be liquid, that reserves have to be secure, that they have to be safe, that they should not be plagued by the suspicion of money laundering or other criminal activities. And as a result, I'm confident that reserves will not enter, that bitcoins will not enter the reserves of any of the central banks of the General Council. I had a good conversation with my colleague from the Czech Republic, and I leave it to him to make whatever announcement he wants to make, but I'm confident that he's convinced, as we all are, of the necessity to have liquid, secure, and safe reserves. Thank you.
And now, Aude Kersolek of BFM Business, French television. Aude, please.
Thank you, Madame Lagarde. Are you comfortable with going on cutting rates, whereas the Fed had stopped? What impact do you foresee? And second question, if tariffs are introduced, do you think monetary policy will have to adapt immediately, or is it necessary to wait for the impacts on activity? Thank you.
Well, thank you very much for your question. I'm comfortable with one thing. We are comfortable with one thing, which is to reach our target. We are mission-driven. We want that 2% medium-term sustainable, and we will do everything that is required in order to reach that goal. So, as I said to another colleague of yours earlier on, under the baseline that we have, and with the data that we have received, we can comfortably indicate that we are directionally on this downward slope, pace and sequence of which will be determined by data and will be decided on a meeting by meeting. And for those who would like to have this solid forward guidance, it would be totally unrealistic to do anything of that nature, simply because we are facing significant and probably rising uncertainty at the moment. So this is what we have to do. And we continue to be guided by this sort of threefold analysis, which includes the inflation outlook, the underlying inflation, and the transmission of monetary policy. So are we comfortable doing what we have to do? Yes, absolutely, because we are mission-driven. The second question you had related to tariff. You know, as I said earlier on, for the moment, there is nothing that we can actually capture in terms of policy determination, in terms of numbers, in terms of scope, in terms of custom line items to understand exactly what is considered. When that happens, then of course it will enter into our assessment and into the macroeconomic analysis that is produced by our staff. But it's far more complicated than it's this way or this way. It's inflationary or deflationary, depending on whether there is, one set of decisions with variable rates around the world, rerouting of trade, whether there is retaliation or not. All we know for sure is that it will have a global negative impact. A global negative impact.
And the next question goes to Silvia Bazzoni of Class CNBC, the Italian TV channel.
Good afternoon, President. Good afternoon, Vice President. So in the statement you mentioned headwinds, and GDP released this morning, of course, were below expectation, especially for France and Germany. So is the recovery delayed, and how long will it take to come out of stagnation? And the second question, you were mentioning before, since December, long-term yields have gone up significantly following especially Treasury sell-off. And this besides the economic divergence between the EU and the US. So are you worried, and how are you assessing the situation? Thank you very much.
Sorry, worried about what?
The yields that are going up.
Oh, yields.
Yeah.
Okay. So is the recovery delayed? First of all, there is recovery. I think that's the first thing that we have to keep at the front of our mind. We went from a very low 23 to almost double the growth in 24. Now, granted, it is not at potential yet, but it's certainly a recovery. And given the job market, given the real income increase, we have good reason to believe that consumption will pick up and will continue to support this recovery process that we expect to continue. We never talked about stagflation. Q4 was stagnation of growth, but it's one quarter. If you look at the whole year, it's a different story. So, recovery there is. Stagflation there is not. Inflation is going down, and we have recovery. Will it be delayed? We shall see. As I said, it's a process that is ongoing, and that has been quite something in the course of 24. So the yield increase, whether you look at the short end or the long end of the curve, yes, it has increased, and it's a global process. It has been predominantly in the United States, but it has spilled over across the world, and the euro area has not been spared of those spillovers. It's largely attributable to spillovers from the US, not only. Partly because of energy prices, but also for other reasons. There is probably less of a downside risk expectation concerning inflation on the part of the markets, which probably explains partly this yield increase. But as I said, largely spillovers, partly euro-specific. But it doesn't stop our monetary policy from transmitting quite materially. When I look at the decline of interest rates for corporates, the decline of interest rates to households for mortgages, it is really channeling through into the economy. And when I look, for instance, at the consumer survey and their intention to invest, there is clearly an added demand on the housing sector, for instance. So more to be seen on that front, particularly fueled by lower interest rates.
And now Olaf Storbeck of the Financial Times. Olaf, for you, please.
Thanks a lot. I have a few questions on the natural rate debate.
Not few.
Can you give us any idea of your views on how the ECB will decide when we are there? So conceptually, will you just take the mid-range of the staff forecast, or have you already discussed how to determine that? And do you have any views on the question, as we are getting closer to the level, wherever it is, will the reaction function of the ECB have to change in terms of, do you have to act more slowly, or kind of take more time to see how monetary policy actually works? Thanks.
It's a nice question. But let's face it. We are currently restrictive. We are not at neutral rate. This is a debate that is entirely premature. When we get closer to that, we will operate on the basis of a staff research paper, on the basis of the analysis provided by staff, and then that will help us determine how close we are and what our monetary policy stance should be. If you're asking me today whether we should go below neutral rate in order to stimulate the economy? I cannot tell you that. That's pretty obvious. We decide meeting by meeting on the basis of data, and we are not pre-committing to any particular pace. So how could I tell you if and when we arrive at this conceptual principle of the neutral rate, what we will do afterwards? This is going to depend on the data that we receive.
Stefan Rechius of Handelsblatt. Stefan, please.
Oh, by the way, we will be also, I mean, I know staff is going to work very hard on models, but we will be looking at all sorts of information, intelligence, you know, the famous reference to looking out of the window. We will also be looking out the window.
Thank you for the floor. Here I am.
Hi.
Hi. You had a dinner guest on Tuesday evening, which, if I'm not mistaken, was the first time. Could you walk us through the exchange with Ursula von der Leyen and what you talked about and how it feeds or fed into the deliberations of the Governing Council? And my second question, if I may, is on the withdrawal of the Fed from the NGFS. The timing was delicate, just days prior to Donald Trump taking office. Did this exit surprise you, either in substance or in timing? Did you expect it, and what does it mean for global cooperation of central banks? Thank you.
Well, thank you for your two questions. President von der Leyen honored us with her presence at dinner on Tuesday. She was not the first one to attend what I, very immodestly call the president's dinners. Pascal Donoghue, the president of the Eurogroup, had also attended one of our dinners. And it was a very rich experience, which all governors felt could be repeated with other guests from around Europe. So I was particularly grateful to the president that she came, despite the crazy agenda that she has. Let's face it, this week is particularly heavy for her, and she managed to come. It gave us a chance to understand better from her expose, her remarks, what exactly the Commission was going to focus on in terms of competitiveness, in terms of simplification, in terms of keeping the goals but being flexible on the approach. And I think that she was herself, but she can speak for herself better than me, pleased with the exchange that we had, because it took the form of her explaining the policies considered by the Commission in order to restore the competitiveness, in order to incentivize innovation, in order to eliminate some of the red tape, and so on and so forth. But it was also a chance for her to hear from the governors what their concerns were, and to check facts and policy recommendations. So it was in that respect really an interesting dinner. And there will be more of those, as I have other guests up my sleeves, which I'm not going to disclose at this point in time. Now, you asked me a question about the withdrawal from the NGFS. The NGFS includes, I think, over 150 countries around the world. We are an active member of the NGFS. We actually provide the scenarios that are used by the NGFS and most members, and we see huge value in this multilateral, comparing of notes, comparing of scenarios, comparing of risks, comparing of policies. I think in this day and age, having a multilateral setting where these issues can be debated and analyzed is of great value. I'll stop here.
And the last question today goes to Elena Stavova from the Bulgarian news agency. Elena, please.
Thank you. Good afternoon, Madam President. I have two questions. First, you mentioned rising real incomes. How far is this process gone, comparing the levels the pre-pandemic levels? And my second question is related to Bulgaria. Bulgaria is preparing to ask for extraordinary convergency report. Do you have recommendations for easing this process and eventual extraordinary convergence report, would it be focused mainly on the technical criteria for entering the Eurozone, or it will take a more comprehensive approach about policies, about legislation again, like the released in June?
Right.
Thank you.
I beg your pardon because I missed the first part of your question. The second part I registered on Bulgaria, the convergence process and all that. But on the first one, what was it?
The real incomes.
Oh, real incomes.
Yes.
Okay.
How far are they gone comparing the pre-pandemic levels?
Yeah. Okay. Okay. So on rising real income, it's a fact, and in many member states there has been a complete catch-up with pre-pandemic levels. What has been different from pre-pandemic levels is the level of savings. And the level of savings has increased, has varied over the course of time, but in net terms has increased. And we very much hope that if confidence can be restored, particularly in view of a degree of anxiety and uncertainty about European political development, for instance, that consumers and investors will restore their previous pattern of consumption and investment. On Bulgaria, there is a convergence process that is well advanced. We are marginally involved in the process because we do not pass judgment on anything else than convergence towards inflation, and we look at the fiscal position and the sustainability. But on those fronts, and from what I have seen and the discussions that I have had with the Bulgarian authorities, I'm confident that this process is going well, and the special convergence report that has been asked by the Bulgarian authorities will, I suppose, it's not my decision, it will be determined by the Commission, will proceed so that there can be a review of all the criteria, not just inflation, but all the criteria that Bulgaria has to satisfy. So I'm only giving you a partial answer because the rest can only be given by the Commission.
Thank you very much. That concludes our press conference today. We will be back on the 6th of March, and until then, I wish everybody all the best. Thank you.